Hi, it's Joe Mazumdar of Exploration Insights. Welcome to the January Metals Investor Forum, the virtual one. Thanks for joining us. And today we're going to have, I'll do an opening presentation of last year of 2020 and some thematics that I see coming up in 2021. And then also we've got several companies here. We've got copper companies, we've got gold companies, and we've also got a palladium play. So we got about a mix of commodities and geographies, Canada to Australia down to Peru. Yeah, let's get started. So starting off, basically my presentation is just about what we saw in 2020 first and what we're going to see, maybe some thematics going forward. Okay, so putting 2020 in the rearview mirror. Basically, this is just a graphic on the winners and losers of what I do in our weekly newsletter, covering some commodities, ETFs, and the U.S. dollar, treasuries, and stuff like that. And so, what we've seen in 2020 for the full year is a weak dollar trend. It's down 6%, which is significant for the U.S. dollar, and treasury yields that dropped, as you can see, about 50% here. Let me just get the laser pointer here. So you can see that big drop in U.S. 10-year treasuries. You can see a spike in the volatility here. So that spike in volatility, drop in treasuries, weakening dollar, you would think would have done better for precious metals than just a 25% return. Obviously, silver is a bit more levered, and so it offered a 46% return for 2020. And so what was driving a lot of the lack of luster on gold, I think, was, this risk-on trade where the S&P was actually up by 16%. And some people had proxied Bitcoin here, which was up about 300% by that time for the full year. That might have taken a luster off gold. But saying that, the other commodities performed well. Iron ore was up 70% because of a resurging Chinese economy after March. We had palladium up 28%, copper 25%, zinc up, uranium, as well as nickel. So if we look at what's driving the risk-on sentiment, the same thing that's driving gold, we see the U.S. Treasury yields drop into record lows here, and those low interest rates are basically fueling the spike in, the continuous records in the U.S. Markets. And so in the U.S. markets, like we're looking at the companies that really outperformed, the background in 2020 is obviously COVID-19 pandemic. And one of the big things was lack of travel, as I can attest to as well as, as the diminishing site visits I've been able to make internationally. And so we've seen, anywhere from a 95%, 80% drop in travel globally. And so what the impact was that the firms that did really well were the ones that helped us cope, like whether it was teleconferencing, like the Zoom thing, home gyms, online purchasing services, vaccine manufacturers. You can see here Peloton, Moderna producing a vaccine, Zoom. And then you see, but the best one was actually Tesla, which was up about, over 700% for the year. But importantly, this is a thematic for the medium to long term in terms of the penetration of electric vehicles and hybrids to reduce greenhouse gas emissions. And as we know, some of these commodities that did well are related to that: nickel, copper, and lithium, to name a few. Okay, and then the other thing we could say is that the U.S. dollar. The U.S. dollar spiked over about 102, in terms of the Dixies, which what will be used as a trade-weighted average of the U.S. dollar when the pandemic hit North America. But since then, it's dropped about 12 to 13% below 90. And so this is something we watch. It's not only going to help gold, but it's going to help every commodity denominated in the U.S. dollar. So that's a good trend if you're looking for commodities. And we like to think that volatility is important for gold as a safe haven asset, but really what we've seen last year, like we saw a significant spike in the volatility index, what we call the VIX, over 80 initially in March. But at that time, gold price really was, plunged to 1,500. And it didn't actually reach its peak in 2020 of 2069. It basically when the VIX was going down and we were off the second wave in the US with respect to coronavirus cases. So in the background, you have here the coronavirus cases in the US, first wave, second wave, and the big third wave. But that didn't really impact gold price. What we need to see is basically those expansive monetary policies that are trying to combat the economic impact of the COVID-19. That's really where we see the impact on the gold price. So if we go specifically to precious metals, the real supporting factor for precious metals is the expansive monetary policies, the lower interest rates, the driving the negative yielding debt to well over 18 trillion. That's supportive of precious metals. And so in 2020, we saw a lot of the countries globally basically cutting rates. This is all the magenta here. And that includes the G7 economies and China. In 2021, the forecast is for no change. And so we're not going to see potentially a lot of rate hikes in the G7 nations, but we might still see cuts in China, which incidentally is also the largest consumer of a lot of industrial commodities. And so the best graphic I can show you in terms of relationship of what's happening with gold is looking at the 10-year TIPS, which is the inflation adjusted or the real rates of interest. And so we can see that gold fell when the TIPS went up in March, and the TIPS was represented as being a safe haven asset. But that trend downward where the TIPS went below 1%, that's when gold spiked up to well over 2,000. This positive trend in the TIPS, which was still in a negative range between 0.6 and 1%, gold basically wavered down. Recently, we've seen another trend downwards, and that's what's pushed gold back up to around 1,900 more recently, towards the end of 2020. The thing that's been taking the shine off of gold is basically Bitcoin. Bitcoin's a lot more volatile than gold, and you could see that in March when Bitcoin dropped by about 50%, when gold plunged by 12%. But if you look at a Bitcoin to gold ratio around that time in March, it was like 3.1 in terms of Bitcoin to gold, and at the end of the year, it went up about 5 times to 15 to 1. But the question really is Bitcoin going to replace gold as that demand for safe haven assets, for negative yielding debt, and for something in terms of a counter to the US dollar? The problem right now is that Bitcoin's volatility may stop it from totally taking over gold, but it's definitely taken a shine off of gold. And what it's trying to say is that it's more scarce than gold because it seems to be very difficult to actually mine or produce these Bitcoins. So in terms of industrial metals, we know that 2020 wasn't a story just about gold. And one of the big things that driving commodities in terms of the medium and long term is this, lowering greenhouse gas emissions, lowering our carbon footprint. And so this is a graphic from BHP Billiton about their commodity portfolio and the big scenario changes, between how they plan on what commodities are going to really do well in the next several decades. And you can see the big change if we get stricter on climate change in nickel, copper, uranium, and these are some of the commodities that we cover. I own equities that are exposed to those. And if we go more specific into electric vehicles and the penetration of electric vehicles and hybrids, this is a graphic from Norilsk Nickel. And you can see that nickel does well with battery electric vehicles, hybrids, doesn't do good with fuel cells, but renewable energy, grid storage, nickel does well in all of those. Battery electric vehicles, PGMs, do less well, but the loading in hybrids is much higher, and platinum does very well in fuel cells. And copper, because of the outright electrification, does well in most scenarios. And so this is just giving you an idea what happened last year with respect to the down plunge in industrial production in US, China, the two biggest economies, the Eurozone, and even Russia, because this is a real slide. But you can see that China rebounded fast because the virus was started there. And that basically helped out the commodities, especially the industrial commodities after March when they hit a low. Going forward, what we can see is that China's still a big part of the nickel and the copper story. But although it's a significant play in palladium and platinum, the EU is equally as important. Okay, so it's not just a China story for PGMs, for platinum group metals. And if we look at what happened with the prices, we can see that the entire complex of base metals, copper, lead, nickel, and zinc, the plunge of about 25% to March, and then the rise after China started coming back online, and also helping that, especially with copper, was production disruptions in Latin America, especially Chile and Peru. So if we look at the background of metals improving, precious and base metals and other industrial commodities, we've seen a recapitalization of the sector. So this is a graphic showing from TMX, basically showing up to November the change in the year-to-date statistics of financings. And so we see a drop of 28% in new issuers and IPOs. We see a 46% drop in IPOs, which is good for this TSX Venture. But as we know, the TSX Venture is not all mining, but is dominated by a lot of junior mining companies. So it's not a bad proxy. But what we can see is the total number of financings went up 25%. But importantly, the financings, the different types of financing, raised 48% more money, for a total of just under $6 billion. And underlying that, because of the increase in valuations, we saw about a 60% increase in the valuation of these companies. I ran my own numbers, and these numbers are different because not only does it do the TSX Venture, but also the TSX, and there's some other transactions like warrant exercises and things like that involved. So I calculate about $9 billion raised in 900 different transactions in 2020, an average of about 10 million per transaction. The majority was gold, copper, and silver, which takes more than 75%. But what we see is that, we saw a rise in financing early in the year, just before PDAC, and this time it was more so because of the impact of COVID. But then, usually when we don't see a lot of financing going into the summer, we were seeing a spike in financings of monthly totals over $1 billion and more than 100 transactions for both July and August. And then closing the year out, we've also seen another spike over $1 billion raised in December, with more than 100 transactions. So the market for recapitalizing the junior sector especially is still pretty buoyant. And the other thing we saw in 2020, a bit constrained, was M&A. So in terms of, because of the travel restrictions we talked about, most of these transactions were between management teams that were either in similar jurisdictions and the company is listed on similar stock exchange, such that the ability to do due diligence was easier. And a lot of these companies had seen the other company's assets or had people already in that jurisdiction that could take a look at it. In 2020, just in terms of what I covered under the letter, I covered about $20 billion of transactions. From a $40 million consolidation of two prospect generators all the way up to $11 billion merger of two ASX-listed companies. But, the majority of this was mid-tier consolidation, trying to get basically more liquidity, as we can see, and I'll talk about that. But we can see in 2021 the potential for more M&A, just because these guys are generating a lot of free cash flow. So this was from BMO Capital data. They looked at 24 different gold producers, market cap over $200 billion. So at gold prices of 1,500, and gold is significantly higher than that, these guys would generate over 5 years, $4.7 billion, sorry, $3.3 billion on average in 2020, from 2020 onwards, in free cash flow over a 5-year period. If we raise that gold price closer to spot, 23% to 1850, that free cash flow generation goes up 60%. And this is the leverage these companies provide. But a lot of this free cash flow is being used to raise dividends. Now we've seen $1 billion Newmont buyback program again. But I think the major majors like Newmont Barrick might have been done with their big mergers, but it's really right now the mid-tiers that are doing a lot of the M&A because they're generating free cash flow. The idea for that M&A continues to be increasing relevance, consolidation, higher market cap, better liquidity, synergy, cutting G&A, generating more free cash flow, diversification of asset bases, better balance sheets, and then raising dividends potentially, and then consolidating pipelines, and then having the ability to fund those, self-fund those, organically fund those pipelines. Okay, and going forward into 2021, we're looking at changing the guard, basically in the U.S. So the top right graphic gives you an idea that, historically, whether it's been a Democrat or a Republican, the stock market really hasn't cared that much. It's gone up regardless. So what's going to change now? So the U.S. Biden administration is proposing a significant, increase in corporate taxes back to 28%, which is probably negative for a lot of these U.S.-based companies. Permitting timelines from the Trump era to now, they might be longer, which is a negative. So we might have, supply constraints, generating less free cash flow, potentially longer time to permit. But on the positive side, infrastructure spending, which would be a demand pull for copper, iron ore, metallurgical coal, and amongst others, expansionary fiscal policies, which would be a positive for precious metals, investment in manufacturing, generating local employment. Mining does that, so that might be a positive for some mining companies. The move away from fossil fuels, the green economy, that would be a positive for all those commodities like copper, nickel, and potentially even uranium. The federal government talking about making more domestic purchases. That's been helpful for uranium and potentially rare earths, as they've set up a strategic stockpile for uranium. And another issue would be U.S. relationships with China. They've already sanctioned over 200 Chinese entities since 2019 during the Trump administration. I'm not sure if that's really going to change under Biden. Okay. The other thing is we've talked, people talk about environmental social governance, or by its acronym ESG. So I pulled together this, this is from Bloomberg, just showing, the returns of these, green companies, so the Environmental Opportunity Share Index. So they're generating higher returns, and people are looking at this not only from the people giving the money, but potentially actually generating higher returns by focusing in on these type of companies that do well on ESG scores. So this is taken from Sustain Analytics. So I basically graphed 108 mining companies and where they score on the ESG. And so, the vast majority score either high or severe risk. The most severe are the Chinese companies, but you've got Rio and BHP here scoring high risk. And these are big diversified companies. Barrick's high risk. The lowest risk companies are basically the royalty companies. Newmont and Newcrest scored in the lower ranges, but the question really is for these ESG funds, is mining incompatible with that directive? And my thoughts, if they want a green economy, then they're going to need metal. And these are the companies that produce it. So somehow that's got to be, conformed. The idea here is that most of them see management teams doing very well, but the underlying risk, whether it's diesel use, water impacts, tailings, waste, all that, is a risk that all mining companies have. Okay. So quickly, I'm just about done. Summary. I mean, we got to watch Bitcoin in terms of its ability potentially to erode the demand for gold. Gold does well in declining interest rates, real rates. But if we continue to have a risk-on sentiment, we'll still see the equity markets go up. There might be, that might tarnish the returns from gold. Resurgence of industrial production from China near to medium term has helped all the commodities, industrial commodities. Potential for infrastructure spending by the Biden administration would help not only U.S., but potentially, Europe might be doing the same thing. And also from the company side, there has been definitely a lack of exploration and development. And so those companies that are in the development stage, where they are right now, help in the medium term. And then the ESG, may be incompatible with some of these funds, but mining companies will still present an important role in the economy going forward for a green economy. So, financings, recapitalization, gold dominant, but we've saw a significant impact on other commodities as well, like copper. So the M&A focus was projects and companies and jurisdictions where the suitor was already so it supported due diligence. Once we see the travel restrictions come off, we could see another wave in M&A.